Good afternoon and good evening. Welcome to Traders Workshop for Tuesday, August 30th. And again, it's my pleasure to have our esteemed guests joining us. Traders Workshop, where we bringing NinjaTrader ecosystem experts to share their expertise with you, the viewer. Before we get into that, though, I do want to remind everybody that trading futures and options contains substantial risk. It's not for every trader. You could potentially lose all or even more than all of your initial investment. So that's why we recommend using risk capital. What is risk capital? It's money that you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not indicative of future results, and that what we'll talk about here today is not intended to be, nor should be taken as trade recommendation or investment advice, but rather for educational purposes only. And with that bit of housekeeping out of the way, I would really like to welcome back to the show Larry Williams. Larry, how are you doing today?
Tom, thanks for having me back. I don't always get invited back to parties and stuff, so I'm honored that you would invite me back. Everything's good. We're back on the U.S. Virgin Islands now, back from Montana. A little different lifestyle down here, but that's a beautiful thing about having something like Ninja with communications. I can be as close to the market now as you are, somebody in Chicago, New York, London. It's incredible how communications and software have allowed us to have instantaneous access to what the market's doing.
Right. And we look at it from a technology standpoint. It's amazing we have access to all this data, forgetting that important point about where you are in the world physically. I mean, you take for granted where I grew up, where Jim grew up, where, Larry, where you grew up in the States, maybe different times there wasn't as much access, but now there is everywhere. And you're traveling between, one of the least populous states, I would say, in the United States to a beautiful location, the Caribbean. I love the Caribbean. My gosh. And you're still right there. You're real time, man.
Still connected. It's amazing. And Montana has actually more cattle than people, and we kind of like it that way. And the Virgin Islands is, it's a far removed, but it's just instantaneous. And of course, that's not the markets that I grew up with. I think part of what that shift in the market, Tom, is that things happen faster now than before, because our pace was slower because you write letters, we got a reply back a week later, we'd check on the market today, maybe do something later next week. But now there's instantaneous access of news, not only just markets, but news. I think sped up the pace of our lives, as well as the markets and how indicators work in the markets.
Right. And even to that point, actually enacting those ideas in the markets, right? I mean, it used to be you'd pick up the phone, you call your broker. Now you don't have to do that. You could just point and click on a chart.
And the broker could be very helpful. I recall one of my brokers telling a story of somebody called up and she said, "Sell them." And he said, "What do you mean?" "I don't sell them all, whatever they are." We were you had a broker as a filter there. Now, when I lecture in public appearances and ask people how many people have lost money, not because of a bad call in the market, but because of not using the trading platforms correctly, almost all the hands go up. Right. You have to be very careful. You understand how the platforms work and which button you click, or you get a lot of trouble.
Right. And I just want to, for everybody joining us in the chat, in the YouTube chat, feel free to put in questions, comments for Larry. Larry has been doing this a lot longer than I have, and we're happy to have him here. Larry, I just have to share a story. I was telling my mom, who likes to listen in but doesn't understand necessarily what we're talking about, but because we're removed, we're hundreds of miles removed, she likes to listen in. And I explained, our show last week, she missed our show, and I said, well, Mom, and this was really one that it was like, and I explained to her, I said, you remember when I met Reggie Jackson? I had a chance to talk to Reggie Jackson. And she said, "Oh, okay, now I get it." So, that was my explanation to her. She's a baseball aficionado. But, for all of those of you watching, I'm very excited to have Larry on it and continue the conversation from last week about, his ideas about the market, his development of his ideas, and I think most importantly, implementation with examples. Okay, so Larry, last week we used some real-time charts. This week, I think you did so much work. I think we're going to just jump right in, unless you have anything else to say.
No, let's do it. I think the best way to learn is by education, see actual examples. So let's do it.
Okay, great. So Jason, if you don't mind sharing, we'll do this. And so I'll let Larry take over.
Well, I think as we mentioned last week, but for those who weren't with us last week, people just have so many indicators. They're terribly redundant. And you need to ask, why is this indicator there? People read books and they put an indicator on because they read about it in the book. I'll get back to books in a moment, but they're all the same. So in my world, each indicator must serve a particular purpose. And we're looking at the past. The past is prologue. We can go to our next slide and look at that a little bit before we get into the indicators. Technical analysis mostly been about overbought, oversold, or for markets under accumulation. It's where we are, and it's how we are right now. That's most technical analysis, and that's why I think it's limited. It doesn't really talk much about the future, and I, as a trader, have to live in the future. I've got to be, thinking about 3 months from now. I'm thinking a lot about October right now, and November, and thinking about what's going to happen the first of 2023. So the indicators don't necessarily tell us about the future. They tell us the condition right here, right now. I want to live in the future. Technical stuff tends to show what happened. It's a regurgitation of prior data. That may not be correct as to what's going to happen. So I really want to see what's going to happen. That's hard to do, to get a glimpse of the future. I think we can forecast, but never 100% correct. The markets are so random, and we're not that good at forecasting to begin with. But we can get an idea of what's going to happen. And Mark Twain, I'm going to talk a lot about today. You talked about Reggie Jackson, Mr. October. I mean, I couldn't even come close to Reggie Jackson. I mean, what a phenomenal person and player he was. But Mark Twain had so much. We're going to talk about Mark today. This is one of his comments that I just love. He said, if you don't read the newspapers, you're uninformed. If you read them, you're misinformed. And that's kind of why I don't pay a lot of attention to news. I'd rather look at my charts and technical analysis, fundamental analysis, because right now there's a plethora of bearishness in the newspapers. So that may be bullish. So news is something that I tried to trade earlier in my career in the 1960s, and I couldn't. And I talked to guys that had been around. I had a friend who was a boardroom marker in the crash of 1929. He always told the story of marking Bank of America down $600. And he said news, you don't know. The news may be good, may be bad. You really couldn't trade off news. So I always think of Mark Twain's comment about that. So we need to know what indicators can do. And if we understand that, we have a better understanding of how to use them. I think that they can show a cycle in a market. I really believe there are cycles in market activity. There are seasonal patterns. I'm going to talk about that today. A couple of really nice seasonal opportunities coming up. As I mentioned last week, I'm going to share with you today some really strong trades that I've taken for several, maybe 11, 12 years now. You can measure, I think, with technical analysis when big money is buying or selling. And if they're buying, most likely then the future, which is what we're interested in, we'll see a rally, and vice versa if they're selling. Professional buying, clearly we can monitor that. The trend is really important. So we need indicators that are devoted just to trend and when trend changes. So that's what I think we need to think about indicators. That's how they operate. In terms of my indicators, the COT commercial index has kind of been the hallmark of Larry Williams. This is something I started in 1970 when a fellow who had been a member of the Board of Trade came and worked for me, Bill Meehan. And Bill talked about the Commitment to Trader report, which then came out monthly, and it came out about a month late, and it was mailed to us. Again, how much things have sped up. And now we get it every Friday, and it's through the last Tuesday of the same week. But this COT commercial index for futures tells us, gives absolute numbers. how many shares the commercials, the users and producers were buying, how many shares the funds were buying, how many contracts the public was buying. So it's incredibly helpful to understand those three players in the marketplace. And that really gives us a sense of the future. As the cycle, true seasonal, work with that today, volatilities, sentiment index have been very helpful. Basically, when the majority of traders are bullish, market's going to come down. The original work was done by this in the 1960s and 1970s in Los Angeles by Market Vein. And we've carried that work forward. So has my good friend Jake Bernstein. And it's a really good indicator. And clearly, when everybody's bearish, the market's going to rally by and large. It gives us an advantage in the game. So those are the look at my indicators, how I think my indicators should work. And
So,
yes, please.
Larry, just real quick, you mentioned we hear it sometimes when everybody's bearish, it's a good start of a rally. I hear the story of when your taxi driver, when we all took taxis back in the day, when your taxi driver starts talking about the market, it's time to sell, because he's talking about getting in the market. Is this kind of the same thing, although in a more sentiment index? Is it based on news, or is it mostly price based?
It's several ways of doing it. The original work was done by measuring the number of newsletters that were bullish or bearish. And Jake Bernstein continued that. I've continued that. That's the background to understand when the public is listening to all these newsletter writers. So it's an absolute mathematical number, not a guess. Like, well, it feels like they're bullish or bearish, but we actually have an actual percent of how many of these people are bullish or bearish as they're expressed through websites, newsletters, et cetera, and a little bit of price data in there as well. So it's a explicit number. I first wrote about this, the indicator we'll be showing today, in 1999, 2000 for Bloomberg. I did a book for Bloomberg about investor sentiment. It's the same indicator we've seen now for 23 years. And I like indicators that hold up, obviously, they work better. And so that's the approach. Really, we just carried the Market Vein idea forward of doing some actual measurement, not just a guess. Well, it feels like everybody's bullish. Not good enough. We need some actual data.
Awesome. I love that. Okay, go to the next slide.
Well, I mean, we all read stock market books, my book included. I love this quote by Mark Twain: be careful about reading health books. You may die of a misprint. Be careful reading technical analysis books. You might die of a misprint, or you didn't read it, or maybe the author was wrong. I see so many books that claim all these things, and when I test them, they don't test out. So you have to be really careful of technical analysis. As I mentioned last week, I think markets are driven by fundamentals, from point A to point B by fundamentals, and they dance along the way. That's technical analysis. So I think there's a lot of voodoo in technical analysis. It can be very helpful, but you have to be very discretionary in using it. I think that's really important. You can't get carried away with it. Well, let's look at how to use these indicators in real time. We're right here, right now, today, and I want to show how I particularly use several of my indicators in the market. And I think it's an educational lesson. Hopefully it will help you. As I mentioned earlier, the commitment to trader is really the backbone of my career. I think that's so critical. As you're looking at the charts here, you can see the red line in the first panel. That's the actual buying by the large professional people in the marketplace, the users and the producers of commodities. The green line, that's the public. You see the public tend to be a trend follower, but they're almost always doing the wrong thing at the wrong time. If you look at the low in 2020, right at the April low, they were heavily on the short side of the market, right at the market low. Currently, they've started to pull down and they haven't been doing much buying. And this is typical. So we can look at them in relationship to professionals. And you notice the professionals, the red line has been high for quite some time. They've been accumulating. So we know that there's a bias to this upside, to the upside for this market, but that's not enough. I think you have to combine these things. So you can then look at, say, the seasonal index, which is the blue line down below. And right now we see the seasonal index is gauge for a bit of a rally coming up about now. So, we have commercial buy and a seasonal bias in the market. That gives me a condition that the odds favor a rally now. No guarantee will rally, Tom, but it's a condition that favors an opportunity that if I get a buy signal, it's probably going to be better than if I just get a buy signal in another place. That's the problem with technical analysis. Most technicians say a buy signal is a buy signal. A buy signal is a lot better in a bull market than a bear market, or in a market's conditions set up to rally than one that isn't. That's really the important point. So
Right. So having that buy signal, two things that I look for is context and confluence, right? So you don't want to take a signal alone, and you want to see where it is in kind of the overall scheme of things.
great way of putting it. We're going to look at it a little bit more in the next chart. When I was a kid, I remember an ad on the radio. People used to listen to radio back then for Anacin. And they always said Anacin, which is a headache medicine, was like a doctor's prescription, a combination of ingredients. And that's always stuck in my mind, that you need a combination of ingredients. And so that's what I do, a combination of ingredients indicators in the marketplace. So now we look at the seasonal pattern. That's the light blue line that you see. We're looking at the bond market, and we see, we're coming up to a point where bonds get very bearish to the downside. And then we can take a look at see what the commercials have been doing, and see, and last time we started to rally, the purple line, they were buying at the lows over here. They're buying at the lows over here. The commercials started to turn negative on this market, and that has timed the seasonal patterns to the downside. So that's, again, a potential setup for a selling opportunity. The green line in the middle, that's the sentiment index, Tom, that we talked about earlier.
Right.
That's when everybody is really bullish. No, it's just a week ago, and the sentiment index is real high. I think 77% of the people were very bullish on bond market. Of course, it came down. And when they're very bearish at the last low, that's the way the markets work. At the all-time high that we saw back here, and there were like 99% of the people were bullish in the marketplace. The way to use this indicator, though, is when you're in a big uptrend, you want to buy when everybody is negative. You can buy here and here. As you start to go in a downtrend, forget the buy signals, because the trend is going to, as the law of gravity will pull prices down. So the trend is down. You want to take every time that the public or the advisors get too bullish on the market, those are our sell signals. So just an index, it's a really good and powerful index. And you need to put it in phase with the trend. You want to take buy signals when the trend is up, when everybody's bearish and we're in an uptrend, take buy signals, reverse when we're in a downtrend.
Got it.
Well, let's look at another chart, I guess. Then you want to go to seasonals, insight to seasonals.
Yep, we got that up.
This is just huge. It's one of those things that wrote the first book about seasonals and commodities way back in 1970. And that work has been carried on by, again, Jake Bernstein, my good friend Steve Moore. A lot of other people have taken seasonals and done more with it than I do, because I'm more of a trader than want to go out and crunch numbers and do all this stuff. So they've done a lot of wonderful work. But one thing that I didn't notice until about 15 years ago is how to really use seasonals, because we all notice that seasonals sometimes work, sometimes don't work. So how can you optimize them as an indicator? And I'd like to talk about that today. It's pretty simple when you think about it. I'll give some examples. The blue line that we're seeing is the seasonal pattern, and the black obviously is price. And what I noticed is here's a seasonal point where we typically go down, a seasonal point where we typically go up. So most seasonal people would be looking for a buy over here, a sell over here, a buy over here. Not enough. What I want to do is see how price is acting at these points. So here's a seasonal low. Price on average has been lower here than here. But this particular year, price was actually equal to where it had been. So this is the point. Price was stronger than the seasonal pattern, which suggests that this year the seasonal pattern will work. That's a huge takeaway that nobody had written about before. By the same token, when price is weaker than the seasonal pattern, is the seasonal pattern straight up, the seasonal pattern's up, but price is not as strong as a seasonal pattern, we should expect seasonal sell signals will work in the marketplace. So, and here's where we have a seasonal sell right in here, markets really decline. However, price is much stronger than the seasonal pattern, so the seasonal pattern probably won't work. And that's a great way of making seasonals more operative, because just because we declined on average the last 20 years in June does not mean we will this year. So I want to compare the market now versus how it usually looks to confirm a seasonal pattern.
And Larry, so with that comparison, are we looking at, we have a seasonal charts I'm used to seeing the whole year, right? We look at the last year and we see the seasonal pattern overlaid. Is that something that when you notice that the seasonal pattern is stronger than the price pattern or vice versa, how long does that last? Are we saying that that's going to last, does that influence the entire year? Does that influence more? Is it more short-sighted? Is it more about the next inflection point?
Well, let's look at our next chart, and I think I can explain that with a current real-time trading opportunity or insight. So we're looking at a market here. There's a seasonal pattern where we usually come down sharply, and price has held this year substantially better than the typical seasonal pattern, which tells me this seasonal rally that we see this year most likely should take place, and as long as the seasonal move is to the upside. So the potential time, which is what you're talking about, how good will this rally be, should be we're going to follow the seasonal pattern. So my bias is to the long side from this general time period to this general time period. Along the way, if we start to see price start to diverge from the seasonal pattern, that would tell us, oh, we're probably not in sync and going to go all the way to the end of the seasonal pattern. But certainly the suggestion now is we should have a seasonal move as we typically do from here to this time frame. Does that help?
Yeah, that does make sense. And this is, to be clear, this is a crude chart, a daily crude chart, correct?
Correct. Mm-hmm.
Yes, right.
And so
yeah.
So clearly I got, well, we have a little bit of a bias to this market at this time. And it can really help. Let's take another look at another example. We can see in the S&P right now, interesting opportunities coming up. We see a big opportunity in October to move to the upside. And so we know that usually we rally in October, not always, but usually rally in the October timeframe. So as we get there, what we'd like to see is the market, which is pulled back a little bit now. Notice the seasonal pattern is lower here than here, right? It's lower here than here. So what we want to see is we want to see price holding above this point. So if price comes down in here, but holds above this point, it's stronger than seasonal pattern, which would tell us most likely the seasonal pattern will work this year.
And when you say this point, Larry, you're talking about the point that's highlighted on the chart.
Right. The big circle that we see here, notice
exactly.
The seasonal pattern is usually lower here than back here in the middle of this year.
Right.
And so that's what on average has happened every year. If we're stronger than that, in other words, price holds above this price point, we should, if we follow the seasonal pattern, we should rally up, come down and make a new low. If we don't make a new low, we're stronger than a seasonal pattern. So on a comparative basis, this is really bullish, that the market is beating what it's done on average. And that's the tip that we should be looking for something in the marketplace.
Right.
That's how I love to use seasonals.
This one, trying to see which one this is.
Let's go to the putting it to practice. It's a little hard to see, but I've got a blue dot right here in the middle. I want to talk about this. This is what I call my Machu Picchu trade. I was at Machu Picchu almost 20 years ago, I guess. We're walking through. They kept pointing out that everything in Machu Picchu is facing for the equinox of the year when they plant crops. And I've done a lot of archaeological work around the world. And virtually, it doesn't matter if you're at Chaco Canyon or if you're in Greece or Stonehenge, everybody back then cited things on the equinoxes. So I thought, I wonder if the equinoxes could have had any application to the stock market, because obviously something's going on there. So I ran home. As soon as I got home, got off the plane and pulled out my computer. Holy Toledo. Yeah, things happen at the equinoxes. So we're coming up into the fall equinox in September. And what I noticed is if you were to sell the S&Ps in September with about 6-7 days left in the month, that's just at the equinox time frame, most always the markets come down. Well, we see that right here, don't we? So this is the vernal equinox sell period, if you will, that leads into that decline that sets up the October rally. So this is, and let's look at the next chart. Let's see, yeah. And we'll go, I love this. We're going to take a walk to the Ninja Park now. This is, I like Ninja Park. And we're going to look at actual examples so you can see how this has actually taken place, which I think is an important thing for us to see. Well, yeah, it's nice in theory, but how is it really done? Yeah, again, Mark Twain, what a writer, Mark Twain, and the problem with any technical indicators, mine or any technical analyst, Mark Twain said that to a man with a hammer, everything looks like a nail.
Right.
And you got to be careful these technical indicators, because if you have seasonal patterns or whatever the indicator is, you can overstate it. So that's why I like to look at actual examples. So now we go back to the last time we saw the seasonal. There's that equinox decline we typically see in the market, and you see the market declined. Now notice the October low, what I was just talking about, typically we're lower here than here. We weren't. The seasonal rally is going to work this year. And in fact, it did work that year. So that's how I like to put these things into actual performance. Here's again, that's a little seasonal pattern that we first saw in the first slide that I showed you that's coming up now, that right at the end of September, look what happened. Boom, we come down. And then we should be making new lows here. Oh no, we're stronger than, and we get an October rally in the marketplace. We'll look at it again. Go ahead. Yeah, I'm sorry, Tom.
Larry, real quick. So equinox, of course, do you consider there's 4 equinoxes? Is that what we're talking about? Right.
Equinoxes, 2 are bullish and 2 are bearish.
Okay, so in the summer and the spring, I'm sorry, in the fall and the spring, I think that's when there's just as much daylight as there is nighttime, right? It's kind of that equal point.
And those tend to be bearish, and the others tend to be bullish.
Bullish, and that's when there's extremes.
Really, yeah. Mm-hmm. Yeah.
Okay, just to level set for people who are maybe new to this and have heard the term but don't really understand what's happening from a physical standpoint or in the real life standpoint, and how it might affect what's happening in around you, in the markets especially.
Right, and clearly this is not astrology. This is something we have data on, hard data. We can research it, and there's no opinion. This is astronomy versus astrology. And right. It was shocking to me to come back from Machu Picchu and say, oh yeah, there clearly things go on. Here we see again, and we should start to decline. And sure enough, whoa, the market just beat up like crazy. And of course, it should have gone lower. That's a seasonal pattern. It didn't this year, which says, yeah, that October rally should work. So to me, the nice thing about technical analysis, let's look at one more chart, is that we can actually look at this and get a sense of how to react to the market. In this case, it didn't work all that well. And well, why didn't this equinox work immediately? Maybe viewers could figure that out, because if they look, they'll say, oh, Larry told me that if price is stronger than the seasonal pattern is usually down here, but the market is much stronger than the seasonal pattern, it may not be as weak this year. So again, that's why I like to compare what's happening right here, right now, today versus the seasonal pattern. If in this case, much stronger than the seasonal pattern, the sells may not be as effective. And that's, I think, the best way to truly use seasonal pattern. I'm just surprised we didn't stumble onto this earlier, but it's a long learning process in this business to figure all this stuff out. But,
it is, and it took you how many visits to different sites to figure that out, right? Not something everybody does, just stepping out of their door every day.
Yeah, I mean, I don't know how I've done archaeological digs all over the world, and I mean, I knew obviously about the equinoxes, but I never programmed them, and I
Right.
did, and it's like, oh, isn't that interesting? Here's another one that we saw. There's the equinox. The market's in a downtrend, and sure enough, oh, look at that. So
Yeah.
why this happens, I don't know. Something's going on here. I cannot explain it, but I know that. Um, there's something taking place at this time of the year. So as a short-term trader, I know at the end of September, there's no magic day, but with about 5, 6 days left in the month, if I get a sell signal, I want to take the sell signal because I have a bias in my favor. I have a better idea of the future than somebody who's just staring at a chart.
Right, right. I've been corrected, Larry, just so you know. There's two equinoxes. The other two are solstices officially. So,
Correct.
my mistake. I apologize for dragging you down that road, but understand what you meant by equinoxes,
Yeah,
certainly.
okay, good.
So that's from Max Imus. Thanks, Max, for dropping that in and participating. We'll
I
try to
think they can all be
minimize.
called equinoxes, but there's a summer solstice and the winter solstice, and then we have the equinoxes at the. Yeah, I mean, just go in a circle. You've got winter, summer, and then you have spring, fall. The fall and
Exactly.
spring tend to be bearish. Maybe that will make things
Okay.
simple.
I
So
like that. I like that.
I've got another example. Let's go. I don't know what slide we're on, but you can just see. Yeah, if you look at that, I mean, my gosh, boom, and there comes the sell signal. So we're getting into September now, and that there will be an end of September. We know that, Tom, without a doubt.
Right,
So,
right.
so we have we like I said last week when we were talking that not all days are created equal. Some days nothing's going to happen. We don't have a bias or we don't have an insight. Well, what I'm looking for is an insight into the markets. Oh, here's an opportunity. I could be wrong. It doesn't always happen. Wasn't perfect. There's no perfection in this business. Um, so I use money management. I use stop losses, but I know I'm approaching a time frame when I want to look for some short-term bearishness at the end of September and some bullishness in the 1st of October. And now with what I'm showing you, hopefully you understand how to read those things when we get there and say, oh, now I see how I can increase the odds more by seeing that I am in phase with the seasonal pattern or I'm out of phase with the seasonal pattern. That's what's critical, not just the seasonal pattern itself. May or may not work. It's how we're doing this year versus the pattern that's going to really make the difference for us.
And so, Larry, when you're looking at a chart like this that we have up here, and you say, okay, when I do the comparison of where prices compare to the seasonal pattern, am I focusing mostly on where we are right now, or are we looking at what it's done so far leading up to now? Meaning, if I see that it's been stronger for a month or two, I'm thinking, okay, yeah, we're definitely stronger. But if it's just peeked its head above versus having that history, are you feeling sure that price is leading or stronger than the seasonal pattern? A peak above versus history above. Sustained price action above. To me, I'd want to see that sustained to have a better judge or a better view into my decision.
Well, I'm generally seeing, am I following the seasonal pattern in the chart that you have generally? Or are the seasonal pattern is lower, is price lower? Yes. I'll go to the next slide that we have. Tom, let's look at that one. So again, are we generally declining that year? Well, no, we are. Let me go back because I have that same slide here. What slide number is that, Tom? Do you see?
This is slide number 26.
Oh, okay. No wonder I don't have it. So I'll go to slide 26. Yeah. Actually, I may not have taken the trade because price is stronger than the seasonal pattern. I worked wonderfully this year. So, like I said, there's no perfection. Are we in a big downtrend? Typical seasonal pattern? No, we're kind of flat. We're not stronger than the seasonal pattern, but we're not as weak as the seasonal pattern. So that's the judgment call in it. But basically, let's look at the next slide. This is in the bond market. We have an opportunity coming up there. So as I get into where the blue dot is, well, how am I doing? Well, actually, Prices are lower, so they're following the seasonal pattern. We're lower here than here, as we should be. The seasonal pattern early was very strong in here, and it wasn't this year. So I said, we've had some weakness. So yeah, I want to take this seasonal pattern in the bond market. And maybe we can we'll look at some more examples of that, and we'll get into real time then. See the same thing again. Seasonal pattern, we should come down. Yeah, we do. We rally up. We don't make a new high. Good. The seasonal sell should work. Oh, yeah, and it worked. So that's it. Now is real time. Okay. Right up to today. So this is the challenge, always on the leading edge of those charts. We don't know the future, but we can look at it and say, well, the seasonal pattern is usually very strong from here to here, right? How are we doing this year? Well, we're not so strong, are we? We're a lot weaker than the seasonal pattern. So when we get into selling opportunity, I'm looking to sell rallies here. Again, money management, stop losses, et cetera, et cetera. But do I have an idea the seasonal pattern to the downside might work this year? Yes, because I've been weaker than the seasonal pattern. We're not as strong as we've usually been this time of the year. I think that's a tell that I can take advantage of.
And we're looking at the bond market here. This is ZB for those of you following on the live stream. These are bonds, and this is a real-time view, or current view.
Yeah. And if we go to the next slide, now we can start to kind of combine this stuff. And here we're looking at the green line, which is my measure of accumulation. So what I want to see is, am I weaker than an accumulation? I'm seeing selling coming in here. Notice price is lower here than it is here, but generally holding this area. But if we look at the accumulation line, it's falling way below. Here's this low. It's way below that low. So there's been distribution in this market. As we had a really strong rally in here, we don't increase buying in this market. So there's been distribution. Now I just have to see the market get overbought. I want to see the market get overbought. Entering this zone, we should see a market decline. And then I would like to see divergence in accumulation. That's the combination of ingredient that I talked about earlier.
Got it. So, that's bonds as well. We do have a couple of questions that I think you answered in kind of not knowing the questions. I think you answered them, but let's ask them anyway. I'm going to try to pronounce this name, Stakehands, STKHNDS. I'm filling in the vowels. Apologize for that. So Larry, are you still of the mindset that the markets are in an uptrend instead of a downtrend? And of course, without knowing the context of time horizon, how would you answer that? Right.
The market is always in an uptrend. That's one lesson I learned from Vic Niederhofer. I mean, I'm so blessed to have a friendship with Vic, because the long-term trend of the market is up. That's a very long-term trend. So I tend to, and I used to always have a bearish bias, and I got beat up so many times being too bearish. So the long-term trend is up as to where we are right now. Well, the long-term trend is up. We've had a pullback in here, and I have a significant capitulation buy signal in the absolute week of the low. So I think we're in a bull market, to answer the question. So long-term up, intermediate term down has started to turn to the upside on this recent rally. We're up 15% off the low, something like that. So to me, it looks like long-term up, intermediate term decline. We've now started to move up. We should pull back a little bit for that October point, and then whoa, hold on to your hats, guys and gals, boys and girls, binary and non-binaries. I think we've started a 3-year bull market.
Wow. Okay. That's great. I'm glad I asked that question. That's a good answer. Martin Schwimmer asks, I've got another one that's similar. Good day, Larry. You suggested that between the end of August, so there is a bit of a time horizon here, and mid-September, a big market bounce will occur. And of course, we have to couch that with could occur. Is this call still valid?
Well, I don't recall that exact call. This is where I am right here, right now. I think that we're forming a base in here. We're going to see some weakness around the end of September, and that sets up the buy point. So my trading point now is, we're going to see the market. We usually rally a little bit before Labor Day. Not a lot, not often. It's not one of the best holiday trades. So we're going to see that September weakness that we're usually seeing. But the big move, which is what I'm trading for, is coming up in October. Typically, if you want to be really specific, about the 19th trading day of October. I used to do seminars where I traded $1 million real time and gave people 20% of the profits. And I always held it in October. So we could trade in October, the 19th trading day of October, because it's a huge bias on that day for the market to start a big up move. So to me, the big move that, and I think we are starting a bull market, maybe a 3-year bull market, should really start to kick in. And even the Cassandras will see it around the end of October.
So Larry, that's a great point. We've talked about this on our show about trading days of the month. We have somebody who contributes to the show, and he makes comments about them. One that came recently was, in the past 20 plus years, this day always was up on the NASDAQ. I mean, without fail, it finished up on the day. So how many of those days, in your experience, and again, you can limit the time horizon, but you say the 19th trading day of the month in October, we just came one, probably was last week or 2 weeks ago in July. How many of those days where you have, in your experience, and if you don't have the answer, we're not holding you to this, but how many of those days do you run across in the course of a trading year?
Well, there's, from memory, maybe 20 some trading days of the year that are particularly bullish or bearish. But you have to be careful. I did the original trading day of the month concept in the 1990s, and a lot of people again have taken that work forward. But I realized after a while that we have a problem, because every trading month has a trading day 1, 2, 3, 4, 5, 15, etc. But they don't all have the same number of days. They all have an end, but you have to look from the trading days left in the month. Because from trading day 12 on, you're going to have different days in each month, or most all of the months. So I also look at trading days left in the month as September. Trading day left in the month, usually with 6 trading days left in September, we usually see the markets decline. So you can't, all trading days have 15 trading days, but then you start to wobble around a little bit. So you need to take my trading day of the month and my trading day left in the month concept to really get the ones that are going to work the best. And even great. Then, they're not always going to be 100% perfect every time in the future. So, you need stop losses, you need money management, all the things we've talked about.
Right, exactly. And of course, yeah, I think we could say for sure nothing's 100%. And we're talking about stacking the biases in our favor, that I don't want to say odds, but just making sure we have enough information that lines up, that gives us a good feeling about our decision making.
Yeah, speculators, it comes from the word specular, spectacles, to observe. So we observe these things, and we're better informed than a gambler who just says, well, red or black, whatever, I don't know what's going to come up. Well, we can make an observation, and then we can make a decision based on those observations. And since we are in October, I brought one of my favorite Mark Twain quotes up for one of our next slides here, I think, that we can share with people. October is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, June. And Mark Twain, a lot of people will skip a little bit here. I think we're close on time. How are we doing on time? We're close to the end.
Yeah, we're close. We can go a little over.
Well, let's go to the slide of Mark Twain. This hunger. Losing is the handmaid of genius. Well, I've had a lot of losing trades in my life, let me tell you. And this man was so brilliant. Losing is the handmaid of genius. Losing is not a bad experience in the market. It can be very beneficial because it makes you work, it makes you think, it makes you study. Just as if you're hungry, you're going to figure out a way to get some food on the table. So I have losses. We all have losses, but use those as opportunities, because that is indeed the handmaid of genius. The great traders I know all got great because they had losses. They studied their losses and found out about what those losses are. And part of that, let's go to the next slide, if you would. you've got to have a defense. We have all these indicators and stuff, but our defense is money management. And don't bet big, and don't bet too often. In other words, don't overtrade. I hear that all the time, right? But these are really the teams that win the Super Bowl in 2023 will be the team with the best defense. And that tells me as a trader, I have to have a good defense. And my defense is money management, maybe trade selection a little bit, but that's almost a flip of the coin. But what is absolute mathematical is money management. Don't bet too big, don't bet too often, and use stop losses. That's defense. That's what's going to keep you a winner in the marketplace. And let's go back to the one more slide. This is Mark Twain was the original bull or bear in the marketplace. When Mark Twain was a newspaper writer in California, he went to a fight. They used to have bulls fight bears. And at that particular time, Wall Street was coming down. And he went to a bull bear fight, and he noticed that the bear clawed down with his hand to kill the bull. The bull raised his horns up to kill the bear. And so he wrote in one of his newspaper articles that a bear was walking on Wall Street, bringing prices down. So people wonder where the idea of bull or bear came from. It came from Mark Twain. And it came from those bull and bear fights. The bull raises his head up, that's bullish, prices should rally. The bear slash down to kill the bull, and that's bearish, the down move in the marketplace. So a little historical lesson here for people is that's the term we use all the time, really came from the one and only Mark Twain.
I love it. I love it. So Larry, we are right up on time. I want to just give you some time to let people know how do they get a hold of your work, and how do they reach out if they want to continue the conversation?
Well, let's go to the very next slide, because we'll close with that. This is the Mike Tyson slide. Let's put that on for just a moment. Everybody has a plan until they get punched in the face. That's why we have to use money management control. We'll have an idea that maybe prices will decline in September this year, but you know what? You could get punched in the face. If people want to get in touch with me, I don't do much anymore. We do some trading. There's a free trading course you can have. I don't publish anything anymore. Of course, we have our indicators at NinjaTrader, so you can follow my indicators there, or go to our website, ireallytrade.com, and you can read about what we're doing now. But I'm kind of into semi-retirement, but if you want to use the indicators I use, go to NinjaTrader.
Awesome. Thank you, Larry, so much. And it's been a treat.
Thank you.
45 minutes goes way too fast from talking to you. And I want to thank everybody for joining us and contributing to the chat. Sorry, we can't get to all the questions, but certainly, go visit Larry's website. There's so much knowledge there. And Larry, again, I wish, you a great rest of the day. And, I'm sure you're in a beautiful area right now. Go outside and enjoy the weather. Maybe there's a little bit more work you have to do, but really, hope you enjoyed the day.
I will. And again, thanks so much for having me here. It's such a wonderful opportunity. I really do appreciate that. Thank you, and for everybody for watching too.
Yeah, I'll say it's really our treat to have you. So again, thank you, and thanks to Louise, and thanks to everybody. And hopefully we'll see you at the end of the day at Bar's closing.
Great. Good luck and good trading.